Imagine you wake up one morning, check the news, and see the same headline everywhere. Another Great Depression is coming. Big banks warn about it. Central banks warn about it. Politicians talk about it. Some people scream that the next 1929 is around the corner. Others say everything is fine and you should just keep buying. Now you are stuck in the middle. On one side, stocks, real estate, crypto, and gold are near record highs. On the other side, you hear that the job market is slowing down, that AI is taking entry-level jobs, and that a single mistake could wipe out your savings. So here's the uncomfortable question. Are we really heading into a new 1929-style Great Depression, or is something even more dangerous happening? Something slower and quieter, where the rich use this chaos to buy more assets while normal people get squeezed, distracted, and left with nothing but fear. In this video, I want to walk you through the truth behind that fear and show you how to actually think like an investor in this kind of environment. Over the last months, you have heard powerful people speak. Central banks in different countries warn that asset prices are stretched. The Bank of England has openly talked about an AI bubble. In the United States, the Federal Reserve says the job market is cooling because companies are not hiring as many people. At the same time, you see stock charts that look strong, house prices that still feel crazy, crypto charts that woke back up, and gold near its highs. To make it even louder, you had one huge trigger. When President Trump talked about tariffs being challenged by the Supreme Court, he said that if those tariffs had to be paid back, it could cause a 1929-style Great Depression in the United States. The moment he said that, headlines went crazy. Wall Street executives, finance channels, and regular news shows ran with this idea. They said, we are in an everything bubble. Stocks at highs, real estate at highs, crypto waking up again, gold at highs, AI stocks soaring. So they ask, if the economy slows down even a bit, could all of this fall at once like in 1929? Before we answer that, we need to clear something up. History does not repeat in the exact same way, but it does rhyme. That means the exact same movie will not play again, but the same themes show up. So if you want to protect your money today, you need to understand what actually happened in 1929, not just the legend. So let us go back into that world. Close your eyes for a moment and picture the United States in the 1920s. It is called the Roaring Twenties for a reason. Jazz clubs, new cars, big city lights, and a feeling that the future can only go up. Factories are pumping out cars, radios, fridges, and all kinds of new products. People are excited about new technology and new comfort. The stock market becomes the hot new thing. It is the social media of that time. People do not just talk about movies and gossip, they talk about stocks. In that world, everyone wants to get rich from the market. It is not only rich bankers or big bosses, it is teachers, store owners, barbers, factory workers. People start to believe that the stock market is a free money machine. And here's where the first big problem starts. People do not just invest the money they already have. They borrow money to buy even more stocks. This is called buying on margin. It is the same idea as putting a small down payment on a house and having the bank lend you the rest. But here it is happening with stocks and with way more leverage. Back then, you could put in $100 of your own money and your broker might lend you 90 more. That means you control $190 worth of stocks with only $100 of your own. When stocks go up, this feels amazing. If the stock rises by 10%, the value goes from 190 to about 209. Your gain is $19 on top of your 100. That is a 19% gain on your cash for a 10% move in the market. People see these numbers and they go crazy for it. But here's the catch. That same leverage cuts both ways. If the market falls by 10%, the value of your stocks goes from 190 to about 171. You still owe your broker $90. After you pay that, you're left with 81. So a 10% drop in the market wiped out 19% of your money. Now imagine bigger moves and you see the danger. This is the first pillar of the 1929 crash. Massive speculation fueled by debt. People were betting with money they did not really have, and the system allowed extreme levels of leverage. As long as prices went up, nobody worried. But once the direction flipped, the same leverage turned small drops into disasters. Now let us talk about the second pillar, the real economy underneath all that hype. The roaring 20s were powered by mass production. Factories could produce cars and appliances faster and cheaper than ever before. Thanks to assembly lines and better machines, at the same time, credit became normal. Before that, if you wanted to buy something, you usually had to save up cash. Now you could buy on installment plans. Companies advertise this as modern and smart. Pay later, live better today. So households used more credit, businesses used more credit, and investors used more credit. At first, this made the economy look extra strong. Sales went up, corporate profits rose, more people had new products at home. It all looked like a win. But underneath, a gap started to grow. Companies were getting more efficient so they could produce more goods with fewer workers. That meant they did not always need to pay more people. Higher wages. In many cases, workers' incomes did not keep up with the amount of stuff factories produced. So you had factories full of products, big profits on paper, but a growing number of people who could not actually afford to buy everything that was being produced. That is a dangerous mix. The surface looks rich, but the base is weak. It is like building a tall tower on soft sand. It looks impressive, but one shock can make it sink. The third pillar is the banking system. While all this was happening, the Federal Reserve, which is the central bank of the United States, watched the situation. They saw high stock prices, booming credit, and strong production. They became worried that the economy was overheating. Their answer was to make money more expensive. They raised interest rates so that borrowing would become harder and more costly. At first, this slowed down some of the most risky behavior, but as rates rose, some companies that were already stretched on credit started to struggle. They had a harder time paying back their loans. Some defaulted. When loans default, banks take the hit. So now banks began to feel pressure. Here's where the fear spreads from companies to regular people. Back then, there was no deposit insurance like we have today. If your bank failed, your savings could vanish. So when people heard about banks under pressure, they got scared. They lined up to withdraw their money. One person hears a rumor and takes cash out. Other people see the line and worry. They join the line. Soon, the bank does not have enough cash to give everyone their deposits back because most of that money is already lent out. This is a bank run. It becomes a self-fulfilling disaster. Even a bank that might have survived fails if everyone panics at the same time. In the early 1930s, more than 1,300 banks went under. People lost their life savings. Businesses lost access to credit. The stock market, which had already started to fall, crashed even harder. Over the next few years, the market dropped by around 90% from its peak. Unemployment went up. Breadlines formed. The Great Depression became a long, painful period, not just a one-day crash. Later, the government created new rules to try to stop this from happening again. One key change was deposit insurance. Now, up to a certain limit, if your bank fails, you do not lose all your money. There were also rules to separate some bank activities and more control over leverage. These tools do not make the system perfect, but they change how a crisis plays out. This is important when we compare that time to today. So now that you understand the three main ingredients of the 1929 disaster, we can ask the real question, how much of this picture is repeating in 2025 and how much is completely different? Let us fast forward to today. Look at what is happening now. You have very high asset prices again. Many stock indexes are near record highs. AI-related companies have pushed tech indexes up strongly. In many areas, real estate is still very expensive and many buyers feel locked out. Crypto markets, which went through big crashes, have bounced a lot from their lows. Gold, which many people see as a safe haven, is also near record levels. On the surface, it looks like a world of endless money again. At the same time, you have voices like the International Monetary Fund and the Bank of England warning about an asset price bubble. They do not pick one single asset. They talk about a broad rise in prices that may not be fully supported by the real economy. Then you have the job market. For a while, it looked strong, but now more and more reports talk about slower job growth. In some areas, job growth numbers are down sharply compared to last year. That is where you hear a new phrase, a jobless boom. That means companies are making good profits, but they are not adding as many new workers. That sounds strange at first. If companies are doing well, why would they not hire more people? One big answer is AI and automation. In the past, if a company wanted to grow, it often needed to hire more people. More customers meant more workers. More work meant more staff. Now companies can use software and AI tools to do some of the tasks that used to require humans. Maybe a customer support team that needed 10 people can now handle the same volume with 6 people plus AI chat agents. Maybe a data team that needed many junior analysts can now use AI tools to clean and sort data faster. This is great for profits. Costs stay lower, output stays high. But for workers looking for stable jobs, it makes the ground feel shaky. So here's where things rhyme with the 1920s. Back then, you had strong corporate profits and high asset prices, but a weak base of worker income. Today, we see strong profits in some sectors, high asset prices, and rising productivity. But many people feel their income does not keep up with the cost of living. Rents are high, groceries are more expensive, housing is hard to afford. People are told to invest and build wealth, but they feel they barely have any money left at the end of the month. That is how a quiet pressure builds up under a loud market. Now, we also have important differences. Our banking system is not the same as in 1929. Today, we have deposit insurance. If your bank goes down, you're protected up to a certain amount. Central banks also have more tools. In 2008 and 2020, we saw central banks cut rates, buy bonds, and flood markets with money to stop a full collapse. They can react faster than in the past. That does not mean they can remove all pain. It only means the movie looks different. Instead of thousands of banks failing in a chain, you might see a few big blow-ups and then a wave of emergency actions by central banks. So when people say we are days away from another 1929, they are usually playing with fear for clicks. But that does not mean there is no danger. It only means the danger looks different. The new conflict is not just whether we have one giant crash or not. The deeper conflict is whether ordinary people get slowly pushed out while assets get more and more concentrated in the hands of those who already own them. If houses stay expensive, if stocks keep drifting up over the long term, if AI replaces entry-level jobs faster than schools can retrain people, then even without a single huge crash, a lot of people can end up on the losing side. That is why you can not only think in terms of yes crash or no crash. You have to think about how to build your own money system that works in both cases. So what do you actually do? The first step is to stop treating the economy as something that just happens to you and start treating your personal finances like a small business. When you panic and follow headlines, you act like a customer who is always reacting. When you think like an owner, you act with a plan. Before you worry about buying the right stock or the right crypto, you need to get 3 basic pieces in place. 1, a simple emergency fund. 2, low bad debt. 3, a clear plan for how every new dollar in your life is used. Let us start with the emergency fund. Imagine your car breaks down, you lose some hours at work, or you have a surprise bill. If you do not have any savings, you are forced into credit card debt. That is one of the worst traps because credit cards often charge interest rates in the high teens or over 20 each year. At the same time, the stock market long-term average return is around 10 each year. So if you're paying 20 interest and earning 10 on an investment, you are still moving backward. That is why for most people, before trying to become a super investor, the first simple goal is to save a small safety cushion. For many people, a number like $2,000 is a basic first goal. It is not a full safety net for months, but it is enough to stop one bad week from turning into a spiral of debt. You can adjust that number to your life, but the idea is the same. You want some cash that is boring, sits in a safe place, and waits for emergencies. Once you have that base, the second step is to attack high interest debt. Think of high interest debt as a leak in your money bucket. Every month it is draining your future. Paying it off gives you a guaranteed return. When you pay off a credit card that charges 20 interest, it is like earning a safe 20 return on that money because you stop that cost. There is no investment in the world that can safely and easily beat that for normal people. So even if social media screams about hot stocks, AI coins, or the next big move, ignore that until your high interest debt is under control. After that, you move to the third step, which is building a simple rule for every new dollar you earn. A good way to think about this is to split your income every time it hits your account. For example, you can decide that 75% of your income is the maximum that you will allow yourself to spend on your life. That includes rent, food, phone, fun, and so on. Then you decide that 15% of every dollar will go into investments. It does not matter if you feel like investing that month or not. It is a rule. Then the final 10% goes into cash savings for future goals and bigger safety. You can adjust the exact numbers. Maybe you start smaller and grow. But the key is this: every time money enters your life, you pay your future self first by saving and investing, and only then pay everyone else. That is how you slowly move to the owner's side of the system instead of staying stuck as a victim. Once that base is in place, we can finally talk about investing in a way that fits this weird moment in history. The biggest mistake people make is trying to time the exact top or bottom. They wait for the perfect moment that never comes. Or they throw money in at random when hype is high and then panic sell during the first big drop. Instead, think in terms of a long series of decisions. If you invest a bit of money into solid assets month after month, you will sometimes buy at high prices, sometimes at low prices, and sometimes in the middle. Over time, this smooths out and you ride the long-term direction of the market instead of trying to guess every twist. Now the question is, what do you invest in? You can think of 3 layers. The first layer is the broad market. These are funds that track large groups of companies. For example, one fund tracks the 500 biggest companies in the stock market. When you buy that fund, you are not betting on one company. You are buying a slice of many. This gives you wide exposure. If some companies fail and others succeed, you still move with the average of the group. Over long periods, these large groups have tended to grow, even with recessions in between. This is the foundation for a lot of long-term investors. The second layer is more focused funds, like funds that track 100 of the biggest tech-heavy companies. These companies often lead in technology, software, and new industries. Many AI-related firms are part of these groups. When things go well, these funds can rise faster than the broad market. But when there is fear and rates are high, tech can fall harder. So this layer carries more risk and more potential reward. The third layer is specific theme funds, like funds that focus mainly on AI, robotics, and similar areas. These funds hold a collection of companies that are directly tied to the AI wave. If AI delivers huge gains over the next decade, these funds can do well. But if AI hype gets ahead of reality for a while, they can drop a lot in a downturn. Think of this as your highest risk layer. You only move into it once your base is solid and your first layers are already in place. You might notice something. None of this requires you to guess the exact date of the next crash. It only requires you to accept that markets move in cycles and that downturns are normal. That brings us to one of the most important mental models for any investor. A simple chain that explains how many fortunes are lost and made in every recession. Panic leads to overselling, overselling leads to opportunity, opportunity leads to profit for the people who are prepared. You can write it as 4 steps: panic, overselling, opportunity, profit. When fear hits, most people look only at the first part. They see the panic and they feel the pain when prices fall. They stop there. But a small group looks at the second half. They know that when people dump good assets for bad reasons, those assets become cheaper than they should be. That is where patient investors with cash ready and low personal debt can step in and buy. Later, when the cycle turns, they are the ones who benefit. This model does not mean you wish for others to suffer. It means you refuse to be the one forced to sell everything at the bottom. It means you prepare now so that any downturn becomes a chance to move forward, not backward. That is the real difference between how the rich use crises and how the average person gets destroyed by them. The rich are not smarter humans from another planet. They just follow a system. They have safety cash, low bad debt, and a list of assets they want to own if prices fall. They understand that fear creates temporary discounts on long-term valuable things. Now let us tie this back to AI, because that is the new ingredient that did not exist in 1929. In the late 1990s, there was a huge wave of excitement around the internet. New online companies went public, stock prices exploded, and everyone said, this is a new era. Then the dot-com bubble burst around the year 2000. Many internet stocks crashed, some went to zero. At that moment, many people said that the internet was just a fad, that it would never become what people promised. Looking back now, we can see how wrong that view was. The internet did not die. It grew stronger. It changed everything from shopping to work to entertainment. But the money did not go to every company. It went to the ones that survived, adapted, and delivered real value. AI looks very similar. Right now, there is a lot of hype. Companies add the word AI to their marketing to get attention. Some stock prices move more on stories than on actual cash flow. At some point, there may be a sharp reset. Prices can drop, weak players can fail. If that happens, many people will say AI is over, AI is not special, AI is useless. But that will not be true. The technology will still exist. The real companies will still build with it. The only thing that will change is who owns those companies and at what price. So from an investor point of view, the goal is not to chase every AI buzz name during the hype phase. The goal is to be in a position where, if and when there is a big drop, you have cash and courage to buy strong AI-related assets at prices that make sense. That means you do not pour all your savings into one single AI stock today. You build your base, you buy broad exposure. Maybe you add a slice of tech. Maybe you add a small slice of AI-focused funds. And you prepare your mind for the fact that there will be big swings. You remind yourself that downturns can be your friend if you do not panic. There is one more side to all this that might be even more important than investing. It is your personal skill set. In 1929, when factories cut jobs, many workers had no backup plan. Today, technology is removing and reshaping jobs again, but this time you have more tools to adapt. The harsh truth is that AI will eat many basic tasks. If your job is only to copy, paste, follow simple steps, or do something that a machine can easily learn, then over time that job will be under pressure. That is reality. But there's also a huge upside. AI will boost the power of people who know how to work with it. If you can use AI to write drafts, analyze data, create ideas, and speed up your work, then you can deliver more value in less time. That makes you more valuable, not less. So while central banks worry about bubbles and news shows talk about 1929, your personal mission is simple. Build a money base that keeps you safe. Build an investing system that slowly pushes you onto the owner's side. and build skills that make you hard to replace and able to use AI as a tool. When you do that, you are no longer at the mercy of every headline. You stop asking, will there be a crash next month? Instead, you ask, no matter what the market does, am I getting stronger or weaker? Now let us zoom out and close the loop. We started with a big conflict. Are we heading into a new Great Depression? People hear Trump compare tariffs and a court decision to 1929. They hear central banks talk about bubbles. They see high asset prices and slowing jobs. The simple story is fear. The deeper story is more complex. Yes, there are real risks. High leverage, high valuations, and rapid tech change can cause painful adjustments. But a copy-paste of 1929 is unlikely. The system has changed. Banks are monitored more. Central banks act faster. The real conflict for you is not if the global system repeats that exact movie. The real conflict is whether you let this noise paralyze you or whether you use it to wake up and build a plan. The payoff is this. You do not have to be rich already to benefit from the next reset. You do not need insider contacts. You do not need to guess the exact day of the next crash. You need a boring emergency fund. You need low bad debt. You need a simple rule for saving and investing every month. You need the patience to keep buying good assets through good times and bad. You need the courage to not panic when others panic. And you need the humility to keep learning skills that the future will pay for. In 1929, millions of people did not have access to this kind of information. They could not open a low-cost index fund from a phone. They could not learn AI tools on a laptop. They could not watch real-time charts and analysis. You can. That is your huge advantage. It is also your huge responsibility. If you ignore it, you will live through the cycle like everyone else and end up wondering why nothing changed. If you use it, even slowly, you can step out of the group that always gets hurt and move into the group that uses every cycle to climb one step higher. So when you hear someone scream online that the next Great Depression is coming tomorrow, you can smile a bit. Not because you think nothing bad can happen, but because you know that you are building a system that works in both worlds. If there's a big crash, you have cash and a plan. If there's no crash but a slow grind higher, you are already an owner of assets that rise over time. If AI takes basic jobs, you are already shifting into skills that AI amplifies instead of replaces. That is how you turn this strange moment in history from a threat into a turning point. The question at the start of this video was simple. Are we heading into another 1929 or something even worse for normal people? The answer is that for some people, yes, this could become their personal Great Depression, even if the charts do not look exactly the same. For others, this same period will be the time when they quietly set up their emergency fund, clear their toxic debt, start investing in a smart way, and learn to control AI tools instead of being controlled by them. The economy will move in cycles no matter what. The only part you control is which group you end up in.